Hey guys, what's up? Stock Retail coming back to you. We had a great earnings call yesterday, and so as I always do, I'm going to go ahead and review that. Take a look at the scorecard that we've tracked for quite a while. For me, all the way back to 2021, just a scorecard I like to look at to kind of measure how we're doing in the business. I'm also going to give a quick update on what I've been calling the Great Unwinding. Had some news kind of yesterday and this morning on that as well, so give a little bit of a shout to that. But otherwise, we'll generally be looking through earnings and seeing a little bit of a forecast view too on what's coming. So, quick side notes. This is sort of that Great Unwinding that I've referenced quite a bit on Twitter and here on YouTube. Just going to share a couple updates on that, then we'll get to earnings. So this morning I saw Wall Street Journal reported that basically there's some allegations that Binance had sort of fired someone internally who had uncovered evidence of market manipulation. So you can go kind of just search that up and find that article, but effectively just confirms something I've said on Twitter at least, and I think on Reddit on Reddit as well, since 2021. So for 3 years, I've been saying some of these guys were part of the market manipulation and the fraud that's been going on, and now just kind of coming out more publicly. So that connects as I continue to drop more breadcrumbs and pull back the curtain more on this sort of great unwinding thesis, which, by the way, really the great unwinding for me is connecting to the AMC squeeze. That's what I'm getting at. So some of the things we've been saying for years coming out in the open. And then really interesting yesterday. So actually, I should have shown another tweet. A couple days ago, Susquehanna came out and you could see basically news that they own over $1 billion in the Grayscale Trust Fund of Bitcoin. So Susquehanna, a huge bank, owns over $1 billion of Bitcoin. Well, then the next day after kind of came out, you could see they've also been scooping up AMC. So like you can see here, 7.5 million calls. Yes, there's some puts, but way, way more calls than puts. And then shares and shares and shares. So they've been scooping up AMC shares and calls, essentially going long after they had bought Bitcoin. So that is all connected to the great unwinding thesis. You can go back to the video before this to see a lot of news that's been going on that as well, and a lot of the the corrupt players who we've been fighting. So go back to the last video before this if you want to know more about that. But generally what I'm saying is so far I am seeing the thesis confirmed, and that's got me really, really bullish for the AMC squeeze. Can't promise anything. I'm just telling you what I believe I see. And then just an important note on all that, and it's part of the thesis, that actually Ape really was the pounce. That all connects. So you can go back, see more on that in the other video. All right, so let's get to the forecast. Sorry, not the forecast, but the earnings. But first, I like to review with you guys like kind of a check on how I'm doing. As you know, usually I publish the forecast before the earnings call, but Adam had done the earnings preview, and so I wasn't able to do that. But I'm still tracking on, okay, what had I said? You know, I kind of have that in my spreadsheet. And in forecasting, you just kind of compare forecast to actuals. It's a normal thing you do so that you can learn and keep improving. So great news. First of all, AMC beat Wall Street. You guys know that already, but also beat my forecasts. But I just want to kind of put out there that I also beat Wall Street. I was more accurate than Wall Street, but AMC beat us both. So that's awesome. Good job, Adam and team. Love to see it. Versus my forecast, I was within 2.6% on revenue. So AMC beat my revenue number by 2.6%. And AMC beat my expense number. So in other words, the expenses were lower than my forecast. So revenue above me, expenses below me. That's fantastic to see, kind of a win on both sides. But you can see I was real accurate on that too, only off by 1.4%. Top drivers, so admissions is fantastic, and you're going to see me highlight this a bunch today, that AMC had market share gains. And so roughly that was about $28 million over my forecast. So I'm just comparing to my numbers here, not to Wall Street. Beat Wall Street by even more, as I said. And operating expenses were a little worse than my forecast. So within all of this, there's some pluses and some minuses. So I had operating expenses a little lower than what they came in at, but I think some of that can even be explained by the market share gains. You bring more people in, you got to staff more to cover that. Attendance was basically higher than I thought, so I'm not too worried about that. More showings means more electricity, all that kind of stuff. So that at least is explainable. And then other expense. So there was a large vendor dispute settlement. It was about $36 million. You can see that in the earnings if you kind of go through some of the write up, not just the numbers, but the actual write up that they give you, some text. And then there were some gains on extinguishment of debt. If you remember last quarter, we were paying off debt, and some of that was paid off at a discount. So that shows up as other income, basically. It's kind of in the expenses, but you can see is when it's negative, it's actually income. So we had a couple of those items in there. That was about $5 million. So effectively, we paid off some debt and saved $5 million on that. Pardon me, on that debt. Okay, let's just go through the scorecard. I do this every quarter. I've done this since 2021 so that we can really track over time. One of the things that I always do in Q1 is you'll see, and you can see just at the top, I'm measuring year over year. A lot of the quarters I'll measure quarter to quarter, but Q1 is pretty much always the lowest quarter of the year just due to seasonality of movies. And so I tend to measure it against the last year so I can track our overall progress. Because a lot of times Q4 is going to be really nice, and measuring Q1 to that is not so great. So we'll measure versus last year, and we'll talk about what's coming as well. The key as I share all these numbers, you'll notice this time I put at the top, the box office year over year, the domestic box office was down almost 7%. It was a little under that. I'm rounding a little bit here, but basically the box office was down 7%. So as you see these numbers, you're going to see that AMC is not down as much as the box office. In some cases, AMC is even up. We'll go through this. And so what I want you to hear there, and Adam said this in the call. By the way, as I go through all of this, I highly recommend you go listen to the earnings call. They recorded the webcast. It's up on the AMC website. I think, and I don't mind saying this, that you are going to get far more value listening to Adam and the team than you will listening to me or any other person on YouTube or on Twitter or anywhere else. Go straight to the source, listen to your management team. That's my point of view. But I do this for us all because I have some background in business and kind of the ability to sort of help pick through the numbers and tell you what I see that's going on. But yeah, go listen to him and then maybe come back to me. So the box office was down 7%. All right, so let's go through the scorecard. How are we doing? So I always look at a host of, or a variety of metrics that I kind of call a balanced scorecard. So some things on here you're going to get from the income statement, some things you're going to get from our cash flows, some things you're going to get from our balance sheet. And I'm showing you all of it so that we have a balanced view of the business. So current assets, that's from the balance sheet. Our current assets are at $900 million, a little over that. That is 23% above the same time last year. A lot of those gains really come from, if you remember, Q2 and Q3 last year were profitable. And then also we have sold shares, of course. Adam has talked about that. But even in the meantime, over the last year, we've paid off $364 million of debt. So we have higher current assets in spite of having paid some debt down. So cash, by the way, is in your current assets, among other things. So green there, current assets going up. That's kind of a measure of liquidity, doing well. All right, so attendance. Actually, I know that you're going to see a lot of these boxes gray, and that's why I really wanted to highlight that the box office was down 7% because attendance surprised me in a really, really good way. So you can see we were down 2% over year, but think about if the box office was down 7% and AMC's attendance was only down 2%, that is telling you we gained some market share. And Adam talked about that in the call as well. And so did Sean Goodman, our CFO. Pardon me, guys. Little frog in the throat today. All right, so the fact that attendance is down less than the box office means we were scooping up market share. And you should be really, really bullish about that because when the box office returns to growth and we also have grown our market share, it's like a multiplier. We're going to go up even faster. And so I'm just super, super excited about that. So that's just a real hidden gem in the earnings this time around that should have you pretty bullish for when this strike blip is over. We ought to be doing better. Interesting to see attendance domestically still not as bad as the box office declines, but was down a little bit. Whereas internationally, we actually grew attendance. So that was kind of interesting to see. And so those are blended into this overall down 2% number. And then food and beverage. All right, so same kind of thing. If the box office was down and attendance was down, you expect food and beverage to be down. But it was, I look at net revenue, by the way, from early on. Someone had asked me like, hey, yeah, we're raising prices, but don't we have inflation? So the costs are going up. So I always look at our bottom line on food and beverage so you can see how we're really doing. And great to see that we only declined 3% on food and beverage in spite of the box office being down 7%. So that's just down 9 million year over year. And guys, on the numbers that we do, that's basically flat. That's really not that bad. And I expected worse in my forecast. So, just consider it too. We're looking at a heavily strike impacted quarter. So I'm just going to be real with you. I'm seeing some silver linings in that personally. If the strike was such a deep impact on us and yet these numbers are not so bad, it means our management team, fought through a storm and have done a great job navigating those waters, some very stormy waters. And this, we could have seen red all over this page and we don't. And so I think that's great. All right, on admissions. So you had attendance that obviously drives your ticket sales, but then we also have pricing in the tickets. So I measure these separately. So admissions, we were down $3.6 million, but notice it's basically flat, down less than 1%. Part of that is because so if you had the attendance was only down 2%, ticket prices were up 1% basically. And so that offset some of the decline in attendance, that effectively our revenues on admissions were basically flat. And just say that out loud. In the middle of a strike, all kinds of movies had moved out. I've shown you in some past videos and tweets about how many movies had moved out of the quarter, and yet our admissions basically were flat year over year. That is fantastic. And I just cannot express enough how much it should make you bullish for when the box office returns, what that is going to mean to some of these results and how much money we're about to make. Okay, assets versus liabilities. That's sort of, Adam has told you a bit about, they continue to work on cleaning up the balance sheet. So this is kind of a measure of that. You could use some other metrics as well, but this is one of the measures that I'm looking at. And I want to just continue to see, I'd love to see our assets growing with our liabilities shrinking. That's a little bit of a broad generalization. There's nuance in there, but in general, you kind of want to see that. So I measure, think of the assets as a numerator and the liabilities as the denominator. Just divide assets by liabilities. So we're up 4% year over year. We were at 77% basically last year and almost to 81% this year. We have been better before, but sometimes that can be a little bit tricky to look at because of cash. So if they pay down debt, we can get a little bit of a different blend there. But or we burned some cash recently, things like that. So just generally moving the right direction, and that's what I want to see. But again, as we grow, I think you're going to see that improve even more. Okay, operating expense as a percent of revenue. So this is something I started tracking, all the way back in 2021, because we knew back then that the box office had not yet recovered. And honestly, at that time, we knew that we were burning cash. It was costing a lot of money to operate the business. And think about, Adam said a few times, and Sean said, we've closed over these past few years almost 170 locations, and we've opened up 60. So net, we're down 109 locations. And so the guys, the management team, men and women, have improved our property mix significantly, which is also why you're seeing better profitability. And so that is definitely in these operating expenses as well. I will say you can see here year over year, and this is very much a function of the box office, in my opinion. You will see our operating expenses as a percent of revenue do not climb as much as the box office climbs. So you're going to see better numbers. In fact, let me just go through it, and then I'll kind of mention a call out here. So we're 3% worse than last year, same quarter, from 94% of revenue last year to operating expenses were 97% of revenue this year. Some of that's going to be inflation, energy costs, employee costs, some things like that are in here. And then remember that the box office was down 7% year over year. So, your revenue, your operating expense as a percent of revenue kind of is going the wrong way when the box office goes the wrong way. That's just intuitive. You get that. But I want to just call your attention in Q2 and Q3 of last year, we were way down at 82%. So we were moving very much the right direction in terms of operating expenses taking up less of our revenue. And you should be hearing that we were getting more profitable. In fact, we were profitable those quarters, as you recall. So we will move back to that as the box office returns. Keep your mind on that. We're going to come back to that in a minute. One of the things I've said, getting you ready for this earnings call for a while, I think I started talking to you about this months ago, was that earnings are a rear view mirror. You're looking in the rear view. So what these numbers I'm giving you include January and February in them, which were our heaviest strike impacts. And here we are in May. So some of those results I'm talking about 4 months ago, and so was Adam and team. And so that's why also I'm quick to highlight what it might look like as we return to a bigger box office. And we will come back to that before the end of this video. All right, so free cash flow, I've told you that's a real important metric. That is going to help you know when we are really generating cash. There are a couple different cash metrics you're going to see in earnings reports, and this is just one of them and one I really like to track. It's something when I worked, I've told some of you, or if you're a newer follower, you might not know, I worked at a Dow Jones company for 21 years. This is something we tracked. Large companies keep an eye on how their cash is moving. And it's a little different than just, you'll see a number like cash from operations. This is a little different than that. This isn't going to be the exact definition, so don't quote me here, but effectively it's kind of how much of the cash that you're bringing in is sort of not all tied up, let's say. That's not quite the right explanation. I guess I'll try to define that in another video. But anyway, so free cash flow was down year over year, so it got a little bit worse. But basically you can see flat. So again, if you're basically flat on managing your cash flow in a 7% decline in the box office, which is your business, that's a heck of a job by your management team. So, and you can see though, it is significant. So minus 239 million, that was not our cash burn, just to be clear. That's why I said free cash flow is its own metric. And I do want to just draw your attention to twice in the post-pandemic era, we have had positive free cash flow. One of those was Q3 last year, which was a really fantastic quarter. So that will come back. We'll see ourselves return to positive cash flows. That's my point of view. But I also just want to be objective and show you the real numbers whenever I do this slide. All right, so accounts payable versus accounts receivable is something else I track. That actually ties to your cash flow. So I'll remind you, or if you're new here, I'll kind of explain to you that accounts payable, think of that as I owe somebody. I've got these bills I'm going to have to pay. Like, let's say we're selling the Planet of the Apes popcorn buckets right now, right? So you had to pay whoever made those buckets, pay a factory. And sometimes you have terms where maybe I'm not paying for 30 days or something. Think about like a credit line. And so if I haven't paid you yet, then I've got that bill in my accounts payable, and I need to track that. And you can find that on the balance sheet. If people owe me money, then I have something called accounts receivable. So you can see AP and AR. So when people owe me money, they haven't paid me yet, I get to count that in my current assets because I'm going to get money pretty soon. And so we kind of count that. It's like the next thing after cash in a way. It's not cash, but I'm going to get paid pretty soon. And as long as my partners don't go bankrupt, they're going to pay me that money. And I'm going to see that soon. So if we track, just think of it as if I can kind of wait to pay you, but I hurry up on making people pay me, then I just keep more cash on my side. And that's going to impact those cash flows. So what I like to see is basically accounts payable. Oh man, I've got a typo here that I think has been here for a few quarters. Accounts payable, you'd like to see going up in a way, and accounts receivable going down. What that really means is I'd like to speed up taking cash in and slow down cash going out. But year over year, what I'm showing you is we kind of went the other way. So a little yellow arrow here. It's nothing big because, you can just see accounts payable was down 7 million. So in a way, we paid out a little more. Accounts receivable up 35 million. More people owe us. So it's kind of the wrong way. It tightens cash, but it's really just not that big a deal. So I'm not giving it a red arrow. there can be all kinds of reasons for the timing of payments, and I trust the team on that. So just my objective point of view is we'll give that a little kind of slightly down yellow arrow, just tightening up cash. But again, as we get to a bigger box office, that's going to start to just kind of not matter anymore. All right, so our total bottom line, the net loss or gain. Look at this. We improved $70 million over last year in a box office that's almost down double digits. That's a big freaking deal. So again, these guys managed the business well. There's some key drivers of that you can see. So the market share gains I told you about. I can see some expense management in the details. And then, so that it was even a month or two ago, somebody asked me, I had told everyone, hey, Q1 this year will be better than Q1 last year. And someone was kind of like, you're nuts. How could you say that when the box office is down? It's because I knew there was some one-time expenses last year. If you go real deep in all these earnings reports, you sometimes see some things. And you guys know that I've tracked this over, gosh, I've got every quarter since 2018. So sometimes you see weird numbers. And so you realize like, okay, that's a one-time expense. And there were weird numbers in last year at this time. So I just knew those were going away. So some of it is just what you call an anniversary, of some things that weren't happening again. But still, $70 million improvement in a down box office. I'm calling that a win. All right, so bottom line, attendance growth in spite of the lower box office. So that's market share gains. I told you that's going to accelerate our results when the box office returns. We beat Wall Street forecasts. AMC beat my forecasts. And debt is down year over year. I like to see all those things. Just waiting on this darn strike impact, and I'm not going to hold the strike against these guys. They're managing through it. All right, a couple things I'd like to show you that I've just shown you these over time, and so I'll just bring them back up. I've shown you our revenue over time, and you can see we've dipped, but I want to show you something specific here. So the orange line is the box office, and the green is our revenue. And I want you to notice how and I've scaled these, but basically our revenue line stays kind of underneath the box office line, but clearly tracks with it. But notice something here. Last year, from Q2 to Q3, notice that the box office was slightly down, but notice how our revenue jumped. So that's about the time that we started getting... So, a couple things happened. So you've got some market share going on. You've also got the fact that we have our premium screens. Adam and team have told you about that. So you get Oppenheimer in there, and you get AMC having really nice market share on IMAX, Dolby, some of the premium screens. And this is about the time that popcorn expanded to like 2,600 Walmart doors, right? So you can see that we've started to shift. It's like the first time where revenue on this view is actually outpacing the box office growth. And you can see we've stayed to the right of it. And you get even the biggest gap we ever had right here in Q4 of last year, which is what? Taylor Swift, right? So, and Beyonce. So Adam has implemented popcorn and candy and Taylor and Beyonce. And obviously we know more is coming, right? Like we've got Billie Eilish right now. So what you're seeing, and I told you this was coming, is AMC's revenue will kind of outpace the movie industry revenue growth. And that's really nice to see. It's making us that much stronger. So I wanted to show you that view. And then just continuing to show you the direction of our debt. Down, 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 down. Our debt. We finished the quarter. You'd find this in the earnings. If you look at the borrowings line, just a little over $4.5 billion. But there was a time we were kind of up towards $6 billion. So just really nice progress, going the right direction on that. And as you know, Adam is talking about moving out the debt maturities. Just kind of starting to point our eyes forward. So one of the things that has me bullish, and you heard Adam and team talk about this, just look at this list. So obviously we've got Kingdom of the Planet of the Apes out right now. You've got John Krasinski's kind of family film about imaginary friends and stuff with a lot of stars in that film. You've got the Amy Winehouse Back to Black film coming, Garfield, Furiosa. Everything I'm hearing about, all of those, is just really fantastic. I'm not going to read this whole list, but the point is you can see, and I've been telling you this for months, if we make it to sort of May, things start to improve. If we make it to June, things start to really cook. and then over the summer we're actually, getting real profitable. So we are to the point. That's why I'm saying, as I share with you these old results on earnings, but here we are. Today is May 9th. We're here, right? And so we're now living in a much better world. So also, it's like you're driving a car. You don't spend too much time looking at the rear view. The rear view tells you some things, maybe teaches you a little bit of how you could improve how you're driving, but the forward view is what tells you what's coming, right? So as the shorts try to hammer on our stock, and as distortion messages are sent to you, just bring yourself to that forward view. Speaking of which, besides all those movies I'm showing you that are coming, and just go back and screenshot that, or go out and look. I've told you before, there's websites you can go find, look at all the movies coming. Here's some other things going on. So Adam updated us on the share offering. This says 124 out of 150, but this should be 250, right? So about half of the share offering is done. And I think that's been in sort of the 320s mostly. That's in the filing as well. You can go find exactly how many shares, and I think it comes out to about 322 a share so far, about half of it done. So we brought in a lot more cash than what I showed you. On that scorecard, I was showing you our current assets. Well, now we brought in even more cash. And you'll recall we've cleaned up a little bit of debt too, like that revolving credit line and some things like that. Short interest. Holy cow. I don't know if you've seen, at least on like Fintel and Ortex and some other spots, it's basically at 55 million shares now, kind of an all-time high. Just insane. The level of short interest. And if you think about how much short interest has gotten piled on since March 31st when Adam announced this share offering, it's my point of view, he pretty much head faked the shorts. He announced the share offering, they piled in on shorts. He kind of waited till the stock recovered and then was selling. So I think there's a bit of a short trap that's happened, and I love to see it. That our debt maturities will be moving at some point. That 2026 debt, he talked about that in the earnings call as well. I've told you for a very long time, I believe we'll refinance that. That is going to drop a real bomb on the shorts, because that's literally like the only talking point they have left is that 2026 debt. And I'm not concerned about it. I'm sleeping well at night personally on that one. Concerts and artist collaborations. Adam said he expects probably, I think he said 2 to 4 a year. Go back to the earnings webcast and check me on that. He said he's talking to a lot of artists. So I think we've got some more big announcements coming. We have the Billie Eilish, obviously, album release. If you can still get tickets, it looked like a lot of those were sold out. You might go listen to that if you're a fan. But he also was referencing kind of some of the Taylor Swift, Beyonce type of things, maybe 2 of those a year or something. So we're going to have some big things coming. Meanwhile, I just showed you all those movies. So if you were to kind of get my forecast on our sort of bottom line, Q2, that'll end here at the end of June, it's going to be similar to Q1. We still had some strike impacts in Q2. Adam said he feels it's a little bit better. My forecast is right around that. I've got it pretty similar to Q1, so we'll see where that comes out. But certainly May and June are now so much better than where we've been, and so I'm feeling like we're to the thrive part. We're kind of rounding into something much better. Q3, back to black, guys. Q3, I think you're going to see probably our best ever quarter since in sort of the post 2019 era, and just amazing to consider that, all things considered with the strike and all of that. So I think Q3 is just going to be amazing. I think you're going to be loving that. Hopefully that starts to really bust open some doors for us. Q4, I think, is going to be the best Q4, to just be really specific. I've got Q3 at better than Q4, but Q4 being the best Q4 of the post-2019 era. So not the best quarter ever, but the best Q4 of the post-2019 era. And actually almost on par with 2019, like getting close to 2019 Q4 numbers, in spite of, I've kind of got the box office being about $500 million less than that same quarter in 2019, and yet I think we're going to hit some similar numbers. Let's see if that plays out. I'd like to see, like, will we have a concert? Where's popcorn going to be? How are candy sales? So some of that, kind of comes into play. How have some of the newer properties ramped up? And then if you consider, if you were to exclude impairment, and you guys have heard me say so many times that impairment is a non-cash expense. So if you exclude impairment in Q4, that's also going to be a positive quarter. So just going to be really, really nice back half of the year, which Adam has been telling you. And then 2025 full year profits, in my forecast anyway, that is going to be amazing. Just imagine a time when AMC is profitable on a full year level, not just a quarter here or there. And then 2026, I'm calling that profits plus plus. Like we start to get really big as a company. And, look, I've told you many times, I still believe in a squeeze. I believe that squeeze might be, I don't like to put any timeline. So I am not saying we necessarily have to wait for 25 and 26. But even if you want to say, oh, man, I don't know how to break the shorts. I don't know when it's happening. At the very least, it's my point of view, we get some kind of longer term squeeze, like a Tesla type of squeeze, because basically what I'm saying is from the back half of 24, now for years, we're profitable. That is a painful, painful proposition for the shorts. So good luck to them. So we may have a VW type of squeeze where it's just violently upward movement. We may have a Tesla type of squeeze where, look, Tesla basically on a split adjusted basis reached like $6,500. So don't tell me it can't happen when we start being long-term profitable and just sort of punching the shorts in the gut over and over and over and over. Which is why I keep saying, hey, at some point that 2026 debt is getting refinanced. I believe that. And then it's just, I don't know who would go short on this company. At least not at these prices. You have to consider shorts are basically buying at all-time highs. All-time lows of the stock is an all-time high for a short. And that is a painful, painful bet that they are taking, in my opinion. So just opinion. But these forecasts, I've shown over time have been very, very accurate. So if you think I'm still right, then what I'm saying is basically we're there. We're to the point where kind of the back half of the year, which is, come on, that starts in July. And really, let me just go back, all those movies, we've got some real big movies here even in May and June. So things are starting to get a lot better. I personally would be scared if I was a short on this company. Okay, so just say it out loud. I'm a big fan of that. We're basically at an all-time high in shorts. Profits are literally around the corner. Artists, huge artists, are collaborating with us as a brand, not with other theaters. We've got popcorn. Adam said it. I think he said 6,800 points of distribution at this point, and one of those being Amazon, right, which is huge. We've got candy ramping up. He actually said in the call it's not a high priority yet, but he said eventually he believes we're going to retail. In other words, going to grocery stores with the candy too. We've got the cash to survive, and we're sort of nearing that thrive timeline. Just say all that out loud, and you realize how bullish you ought to be. All right, which brings me to my point, and obviously chose this movie. By the way, actually, real quick, this is another streamer making a movie. I think this one was Apple, that they're bringing straight to theaters, right? So continuing to see great progress on the Amazons and the Apples of the world bringing their product to theaters because they see how profitable it is. And so we will win. Let's go.